Welcome to the Deep Dive. We're digging into Univest Financial Corporation today, ticker UVSP. And looking at their Q4 results from last week, it's a bit of a puzzle.
It really is. It's a classic case of what I'd call headline dissonance.
Right. The company posts a record year for earnings per share, but the market just gives it the cold shoulder. The stock slid, over 2%?
Yeah, closed down at $32.72. And the volume wasn't light either. We're talking nearly 180,000 shares. That's not retail noise. That's institutional money moving.
That's what I don't get. How does a bank beat consensus, declare a dividend, buy back its own stock, and still end the day in the red?
Well, the answer, I think, is hiding in plain sight. It's in a metric called excess liquidity, and it creates a kind of optical illusion in their net interest margin.
Okay, so let's set the table before we get into the weeds on that. What did the numbers actually look like?
The numbers looked good. I mean, really good. For the full year 2025, they hit a record EPS of $3.13.
And for Q4 specifically, GAAP earnings came in at $0.79 a share. The street was looking for $0.78, so that's a clean beat.
And the top line, the revenue, was even stronger. They landed at $84.57 million against an $82.54 million consensus. So, more cash coming in the door than anyone expected.
And they're putting that cash to work. A $0.22 quarterly dividend was declared. But the thing that really jumped out at me was the buyback.
Oh, the buyback was aggressive.
They took out roughly 480,000 shares in one quarter.
At an average cost of $32.17. I mean, you have to understand, when management retires that many shares, that's not just a program. That is a loud signal.
It's them drawing a line in the sand. They're saying, we think our stock is cheap right here.
Exactly. So you've got a revenue beat, an earnings beat, a dividend, and aggressive buybacks. And yet, the stock drops 2.09%.
Which brings us to the core of the problem, the net interest margin, or M.
This is the culprit, the reported NAM. It compressed. It dropped 7 basis points down to 3.10%.
And in banking, margin compression is always a red flag, right?
Yeah.
It implies you're paying too much for your deposits or not charging enough for your loans.
It's the first thing an algorithm looks for. It sees margin down, and it just hits the sell button. No questions asked.
But management on the call spent a ton of time explaining this. They kept saying it was situational, not structural. They used the term excess liquidity.
Right. And having too much cash sounds like a good problem to have, but it can really mess with your efficiency ratios.
Okay, so break that down. What happened?
So in Q3, Univest got a huge influx of public funds. Think municipal deposits, local government tax money. It's seasonal.
And it's sticky, safe money.
It's safe, but it's basically dead weight. They can't lend it out on a 30-year mortgage because they might have to give it back next quarter, so they have to park it in very low yield, short-term assets.
So let me see if I get this. It's like a fancy restaurant that makes all its money on expensive wine, but one month they're forced to sell thousands of cans of soda. Their total sales go up, but their average profit margin plummets.
That's a perfect analogy. The soda, in this case, the municipal deposits, dilutes the overall profitability percentage. And they quantified it. They said that cash dragged the margin down by about 27 basis points.
27 basis points. Okay, so this is where the core IM idea comes in.
Exactly. If you strip out those low-yielding public funds and just look at their actual core banking business, the margin didn't shrink. It actually expanded.
It went up.
It went up by 4 basis points to 3.37%. So the core engine is actually getting more profitable, but the headline number is getting dragged down by this temporary cash bloat.
And they have a plan to fix that.
They do. Management guided that they expect about $100 to $150 million of those public funds to flow out of the bank each quarter in the first half of 2026.
Which sounds like a bad thing. A bank saying our deposits are going down usually sends investors running for the hills.
Usually, yes. But in this case, that shrinkage is the cure. As that low-earning cash leaves, the balance sheet gets smaller, but the actual dollars of interest income they earn barely changes.
But the ratio,
the NIM, mechanically pops right back up. They're putting the balance sheet on a diet to make the metrics look healthier.
that is a critical point. The shrinkage is a feature, not a bug. Okay, let's look at the other side of the balance sheet loans. How did they do on growth?
After a kind of slow start to the year, they finished strong. Q4 saw loan growth of about $129 million. That's a 7.6% annualized rate.
Which is pretty solid in this environment. Where is that growth coming from?
It's a strategic shift. They're letting their residential mortgage book, specifically the construction to perm stuff, just kind of run off. They're pushing hard into commercial lending instead.
Better yields there, stickier relationships.
Exactly. It's a much better business for them long term.
There was a question on the call about their ag book, agricultural lending. That term always makes me nervous. I just picture a 1980s farm crisis.
I get it, but you have to understand the portfolio. This isn't, massive corporate agribusiness. It's small family farms in central Pennsylvania. Dairy, crops.
But what's the collateral?
That's the key. It's all real estate secured. They aren't lending against a potentially bad harvest. They're lending against the land itself.
And that land value is stable.
Incredibly stable in that part of the country. So it's a very conservative, very well underwritten book of business.
Okay, let's talk credit quality. Because with rates where they are, you'd expect to see some cracks. More bad loans.
You would. But their numbers went the other way. This was the big operational win that got totally buried by the margin story. Non-performing assets. They dropped significantly.
From what to what?
From over $52 million down to $37.8 million. That is a huge cleanup in a single quarter.
How'd they do it?
They had one large problematic commercial loan that was on non-accrual. That means they weren't even booking interest on it.
Yeah.
Well, that loan got paid off in full.
And because they had already marked it down?
It resulted in a recovery, a $449,000 gain. Just found money straight to the bottom line.
Nice. So they're cleaning things up, but are they still being cautious?
Oh, yeah. The provision for credit losses was still $3.1 million. Net charge-offs were about $1.1 million. It's not zero, but for a multi-billion-dollar loan portfolio, it's very, very stable.
Stable is good. I also want to touch on their deposit strategy, what you called the ground game. They're targeting title companies, labor unions, and law firms. Why those groups?
Because that's where you find the holy grail of banking. Non-interest-bearing deposits.
The free money.
Basically, yeah. A title company holds millions in escrow. They don't need to earn interest on it for 3 weeks. They need perfect service, wire transfers, fraud protection. If Univest can win that operating account, they get millions in zero-cost funding.
And that permanently lowers their cost of funds.
It's the whole game right now. They expect fee income to grow 5-7%, which tells me they're confident they can win some of those accounts.
Let's pull back to the 2026 guidance. Loan growth of only 2-3% feels a little sleepy.
It does, until you look at the next line item. Net interest income growth of 4-6%.
So loans grow by, say, 3%, but the income from those loans grows by 6%.
That's the margin expansion doing all the heavy lifting. It's about profitability, not just size.
This brings me to what I think is the most important comment from the entire call. The CFO said they do not want to grow their regulatory capital ratios. Why would a bank not want more capital?
Because a bank's performance is judged on return on equity. Equity, or capital, is the denominator. If you just keep piling up profits and don't grow your business fast enough, your ROE sinks. You become inefficient in the eyes of the market.
So they have a good problem. They're making more money than they can prudently lend out.
Exactly. They're generating excess capital, and if they just sit on it, their metrics get worse, so they have to give it back to shareholders.
And the easiest way to do that is?
Buy back stock. They have no choice if they want to keep their performance ratios in line. It's a mathematical necessity.
Which explains the guidance for $10 to $12 million in buybacks per quarter next year.
That's a guaranteed buyer for $40 to $48 million of stock. Think about what that does. It puts a massive floor under the share price. Every single day, the company's in the market buying.
So you're not just betting on the story, you're betting alongside the company's own Treasury Department.
And that ties into their macro view. They're modeling for 2 Fed rate cuts in 2026, and they say they're ALM neutral.
Asset liability management neutral. Meaning they're hedged. They don't really care if rates go up or down.
Right. They're insulated from that volatility, which a lot of their peers are not. So let's put it all together. You have a bank that was sold off by algorithms because of a temporary balance sheet issue.
An issue that is actively being fixed.
While the core business is getting stronger and management is forced, mathematically, to buy back a ton of stock.
And the market is missing it.
Completely.
Which brings us to our favorite part of the deep dive, where we try to spin this into a trade idea. Okay, disclaimer time. This is not financial advice. We're just exploring ideas based on public information. Please do your own homework. Don't risk money you can't afford to lose.
Couldn't have said it better myself.
All right. I'm calling this trade the municipal money squeeze.
I like it. Lay it out.
The setup is simple. The market punished UVSP for the headline IM compression. It saw the watery lemonade and sold. But we know that extra water, the public funds, is draining out over the next 2 quarters.
So you're just betting on the calendar?
The betting on the math. When the Q1 earnings report comes out in April, the algorithms that sold the stock are going to see a headline that says NIM expansion, and they're going to buy it back. It's a purely mechanical trade.
So the trade is long UVSP. You buy the market's misunderstanding today, and you plan to sell when it finally understands in a few months.
That's the long side. But there's a pair for it. You mentioned other banks are asset sensitive.
Right, the ones that need high rates to survive. Their margins are going to get squeezed if the Fed actually cuts rates like UVSP is modeling.
So there's the trade. You go long UVSP, the rate-neutral bank with a built-in optical margin tailwind, and you go short a basket of those asset-sensitive regional banks who are facing a rate cut headwind.
I see. It's a relative value play. You're betting that UVSP will outperform its peers as the rate environment changes.
You're isolating the alpha. And the best part is you get paid to wait. While you're waiting for that April earnings report, you're collecting a dividend.
And you're riding the coattails of a company that is guaranteed to be buying $10 to $12 million of its own stock every single quarter.
You are literally front-running a guaranteed buyer. It's an arbitrage on the market's inability to look past a messy headline number and calculate core NI.
It's a very compelling setup. The risk is that it takes longer than a quarter for the story to play out, but the fundamental mechanics are all pointing in the right direction.
And that's really the story here. Univest delivered a record year, but the market sold the news. The real opportunity isn't in what they did last quarter, but in the balance sheet cleanup that's happening right now.
The market saw a bank shrinking and got scared. We see a bank getting more efficient.
That's the takeaway. Thanks for joining us on the deep dive. As always, do your own diligence. We'll have the links to the earnings transcript in the show notes.
Check them out.
We'll see you on the next print.